Internal rate of return, so this is another measure that is often used in companies, and the basic idea with IRR is that it tells us about the return on a given project. So before we get into the complicated sounding definition, let's just look at something that is very intuitive. Say on a given project you invest 100 and 1 year later you recoup 115. What's the IRR on this project? And the answer is pretty straightforward. The IRR is 15%. And why do we say that? We've invested 100, 1 year later we get 115. So we made a profit of 15 on 100. So IRR is 15%. What if you do another project where you invest 100 and you then get 20 in year 1 and 120 in year 2? Here again it's easy to see that the return on this project, which is the IRR, is equal to 20%. So IRR is essentially the return that you are getting on a project given the cash flows and given the timing of these cash flows. Now things can get slightly complicated if the numbers are like this. So let's say you have invested 100 and then after 1 year you get 70 and after 2 years you get 60. So what's the IRR here? Now this is not easy to calculate, so we need to know a definition that will allow us to calculate IRR, and that definition is given right here. IRR is the discount rate that makes the present value of future cash flows equal to the investment outlay. So let's do it this way. What's the initial investment outlay? That is equal to 100. What's the present value of the future cash inflows? That's equal to 70 divided by 1 plus IRR plus 60 over 1 plus IRR squared. So that IRR, or that return, which will make the present value of these cash flows equal to the cash outlay, is our IRR. So if you use a trial and error method, you can use different interest rates and figure out which interest rate will make these two equal to 0. Some textbooks will describe this as follows. It will say that IRR is that rate which makes the NPV of a project equal to 0, and that effectively is the same thing, where the NPV of the project is simply equal to minus 100 plus these two terms. So it's just repositioning the terms in the same expression. So this now from a calculation perspective is doable, because you have one equation, one unknown, but on the exam you must do this on the calculator, which we will see on the next slide. In terms of the IRR rule, you do a project if the IRR is greater than the required rate of return, and you reject a project if the IRR is less than the required rate of return. Now instead of required rate of return, you might also see WACC, or weighted average cost of capital, and the intuition here is quite obvious. If on a given project you are getting a return of say 14%, so if IRR is 14% but your cost of capital is equal to 16%, then it clearly does not make sense to do this project, because it's costing you 16% to raise money and the project is only giving you 14%. So clearly you reject this project. On the other hand, if IRR is equal to 19% and WACC is still 16%, then it makes sense to do this project. So make sure you understand this. A common mistake people make in the heat of the exam is to see a positive IRR, say like IRR equal to 14, and say it's greater than 0, so we accept it. But that would clearly be a mistake. Make sure that you compare the IRR with the cost of capital before deciding what to do with that project. So as promised, let's also look at the IRRs of the two cash flows that we just saw. And here again are the cash flows, and I will not even attempt to do this the long-winded way using the equation. So you have to do this very fast on a calculator. So as before, you plug in all your cash flows, and then after entering the last cash flow, you make sure that the frequency of the last cash flow is 1, and then hit the IRR button and the compute button, and that is going to give you the IRR for the project. The payback period for a project is the number of years it takes to recover the initial cost of the investment. This is easy to calculate, easy to explain, and a nice indicator of project liquidity, because projects where payback period is short means you get your money back faster. So these would be considered more liquid. Drawbacks means that the drawbacks of this method are that they do not really measure profitability, do not consider the time value of money, and do not consider the risk of a project. So let's take a very simple case where at time 0 you invest 100, and then in time period 1 you make 50, in time period 2 you make say 40, and then in time period 3 you make, let's say, 20. So the payback period for this project A is between 2 and 3 years, and to be precise you extrapolate. So in 2 years you've made 90, in 3 years you have made 110, so the payback period for this project will be 2.5. Now let's say that project B has cash flows like this, so minus 100, and then 50, and then 10, 10, 10 for, let's say, 20 years. So for this project the payback period is much longer. So if we are simply using the payback period method, project A will be selected. However, given that we are getting these $10 for a much longer period of time, the profitability of project B is much more. So based on this example, you can understand the advantages as well as the drawbacks of the payback period. Discounted payback method uses the present value of estimated cash flows, number of years to recover the initial investment in present value terms, and must be greater than the payback period without discounting. Drawbacks are the same, the only one is that we are now using the present value. So very briefly again, if we look back again at project A, where you invest 100 and then you get 50 and then 40 in, so 50 in year 1, 40 in year 2, and then 20 in year 3. Then to calculate payback period, rather than simply using the undiscounted cash flows, we take the discount rate. Let's say the discount rate is 10%, and instead of using 50 we will use the 50 over 1.1. Instead of using 40 we will use 40 over 1.1 squared, and here we will use 20 over 1.1 cubed. So all we are doing is, rather than using the actual cash flow, we are using the present value. But so all the advantages and disadvantages are the same as what we just saw. Only one less drawback is that we are considering time value of money. Profitability index is very closely related to the NPV method, because the profitability index is simply the present value of a project's future cash flow divided by the initial investment. So the profitability index has two formulas. One is present value of future cash flows divided by initial investment. So let's say that on a given project the initial investment is 100 and the present value of future cash flows, so this does not include the initial investment, so let's say that the present value of future cash flows is 120. So this will give a profitability index of 1.2. The other way of looking at this is as follows, where profitability index is 1 plus NPV. So in this simplistic example, the NPV would have been 20 divided by initial investment, which is 100. So this is equal to 1.2, and that essentially shows you that both these are equivalent. And as is again fairly obvious, you invest in projects where the profitability index is greater than 0, and you reject projects with a profitability index less than 1. So again, invest if profitability index is greater than 1, reject if profitability index is less than 1. Now let's talk about the very important concept of the NPV profile. So NPV profile simply takes the cost of capital or the discount rate on the x-axis and different NPVs on the y-axis. So let's take two projects, the blue project over here. So this is the blue project and this is the red project. Now how do we calculate the NPV profile? So take a simple scenario. So on the blue project, let's say that our initial investment is 100 at time 0, and over 3 years, so this is time 0, time 1, time 2 and time 3. So let's say over 3 years we have a situation where you make 500, 400 and let's say 300. So for this cash flow, you determine what is the NPV at different discount rates. So to calculate the NPV of the blue project, we take different discount rates, and at different discount rates we come up with the NPV. So at a discount rate of 0, the NPV is simply the present value, is simply the undiscounted cash flow. So minus 100 plus 500, 400 is 900, 1200. So 1200, actually just to make this simpler, let's say that the initial investment is 1000. So this will give us a NPV of 200. So on this project then we have 200, and then as we increase our discount rate, so we make 5%, then the present value of these future cash flows will become a little less. So at 5% we have a certain number, and then at 6% we have a certain number, and so on. Now what's the significance then of this 200? 200 is simply the sum of the undiscounted cash flows. So the y-axis intercept is the sum of the undiscounted cash flows, and this point over here, the x-axis intercept, notice that at this stage NPV is 0. So this is the IRR, because if you just recall from our earlier discussion, IRR is that rate which makes the NPV equal to 0. So from an exam perspective, this is important. Because most probably on the exam you won't be required to do too much computation, but as long as you remember that the NPV profile on the y-axis is simply the undiscounted cash flows, and on the x-axis the NPV profile. So on the x-axis the intercept represents the IRR of a project. Now similarly we can calculate the NPV profile of this red project, where this point represents the undiscounted cash flows and this point represents the IRR for the red project. So you can plot both these on the same graph. This point here is referred to as the crossover point. So the crossover point is that rate of interest, let's say this is 10%. So this is the rate of interest or rate of the cost of capital where both projects give the same NPV. Now the question that might also come up is which project is better, and if you are doing purely an IRR analysis, then you would pick the blue project over the red project because the blue project has a higher IRR. So you would say that the blue is better. But if you do a NPV analysis, then it depends, because if you use a rate of 6%, then the NPV of red is better. So to the left of the crossover point you would select red, to the right of the crossover point the blue project looks better. So here blue is better. And then there comes a stage, so after this point we would only select blue, and after this point both projects give us a negative NPV. But the core point is this, that to the left of the crossover point there is, so if interest rate is say 6%, then there is a conflict between IRR and NPV, because IRR is saying blue and NPV is saying red. And in this case we go with the NPV method. So whenever there is a conflict, go with NPV. And to the right we have, so on the right there is no conflict, because both NPV and IRR say that we should go with the blue project. So that says that, say the discount rate is 14%, then the blue project has a higher NPV, and as you can see the IRR for the blue project is also greater. From an exam perspective, again it's important to understand advantages and disadvantages of IRR and NPV. So let's look at NPV first. It's a direct measure of the expected increase in the value of a firm, and theoretically it's the best method. So whenever there is doubt or conflict, NPV is theoretically the best method. Disadvantages that it does not consider the size of a project, and also related to this is you don't necessarily get a sense for the return that you are getting. So point here being, let's say you invest $1 billion and you have a NPV equal to let's say NPV equal to 1 million, versus you invest 10 million and here also let's say that the NPV is equal to 1 million. So NPV analysis will imply that both these projects are equally good. However, from a return perspective, clearly if you can make 1 million on a project where your investment is 10 million, so clearly from a profitability and a return perspective, this project seems much better. And IRR gives you a sense for the return on a project. So if you are to look at projects A and B, the IRR for project B will be much higher than the IRR for project A. So it shows the return on each dollar invested, and we can tell how much below IRR the actual project return could fall. So these points are, this is actually the critical point, that you are getting the return on a project. Disadvantages: the possibility of producing rankings of mutually exclusive projects different from NPV. So as you saw with the NPV profiles, it is possible that if we have mutually exclusive projects, then IRR gives a result different from NPV. If that happens, go with NPV. Another disadvantage is that we might have a situation where we have multiple IRRs or no IRR for a project. And this happens if we have something called unconventional cash flows, where the cash flow sign changes more than once. So with unconventional cash flows, you might either have more than one IRR or you might not have an IRR. And if you don't have an IRR, that does not necessarily mean that the project is not profitable. That simply means that you need to make sure you do a NPV analysis. On a calculator, if you have either of these problems, you will get a error. Another issue with IRR is that it incorrectly assumes that money is reinvested at the IRR rate. So if you take a simple project like this, where you say invest 100 initially, and then let's say that you get 70, and then let's say again 70 at the end of 3 years, and the IRR of this project is reasonably high. So for what this project assumes is that this cash flow that is generated is the IRR calculation assumes that these cash flows are reinvested at the IRR rate, and this IRR rate might be much higher than the cost of capital. But NPV correctly assumes that these cash flows are reinvested at the cost of capital. Theoretically, that's a better assumption, and for the exam you must memorize all these three disadvantages. The popularity of capital budgeting methods. This is a general segment at the end of your CFA reading, which is simply saying that which method used. So you studied NPV, IRR, payback, etc. So which one of these are used in the real world? In textbooks, finance textbooks, a lot of emphasis is placed on NPV and IRR, but the point made in the curriculum is that depending on what part of the world you are in, or depending on the size of the company, public versus private, management education, different methods might be preferred. In the US, NPV method is pretty heavily used, and a subtle point made is that in a few European countries that were surveyed, according to a study that is quoted in the curriculum, in Europe, several large European countries make a lot of use of the payback method, and some, in fact, in some countries the use of payback is possibly a little more than the use of NPV. Larger companies would tend to rely more heavily on NPV and IRR. Public versus private companies, large public companies would again rely more heavily on sophisticated techniques such as NPV, IRR, and management education. So larger companies where you have MBAs in senior management are again more likely to use NPV and IRR. The final point is that is the relationship between NPV analysis and stock price. NPV is a direct measure of the expected change in firm value from undertaking a capital project. NPV is the criterion most related to stock prices. A positive NPV project should cause a proportionate increase in a company's stock value. So as you will see later on in the equity segment, a key method for valuing a stock is to look at the present value of future cash flows, and that essentially is what NPV is doing for a given project. So if a given project is adding substantial value as measured by NPV, then that value should be reflected in the stock price. Basic concept, and I would encourage you to look at the example in the curriculum which illustrates this very well. In fact, I would suggest that look at all the examples in the curriculum, because for this reading they are pretty short and relatively easy to understand. So do the examples, do all the questions in the curriculum, and also do the questions from whatever study notes you are using. And as a final request, if you have any feedback or comments on this presentation, please indicate them below the video, so then I can improve the next video. And if you like this video, then please click on the like button. Thank you. That's it for now.